The following podcast was recorded on Wednesday, July 7th, 2021, featuring Ben Breitholtz of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to Talking Data. I'm Kristen Radosh of Arbor Research and Trading, joined today by our presenter, Ben Breitholtz of Arbor Data Science. Welcome, Ben. Today we're going to be talking about the rental market. Rents are rapidly rising, and we're wondering how long it's going to take to hit OER. One of our first charts we'll start out with today is a rent index comparison, apartment list versus Zillow, which I know are two of our most accessible sources. What is this telling us?
So, we started to pick up on this in really kind of February of this year, and we were, kind of alerting clients to the fact that OER and really rents that are used to calculate OER, which we'll get into why that's kind of weird and how the BLS does it. But they started to show inertia and rising, and not just in kind of funny spaces that, in suburbs or rural areas. It was also starting to happen in the big behemoths that are New York City, San Francisco, Chicago, and so on. So we have a fun GIF that we put together that really is combining on a metro level the Zillow data, their rent estimates, which they call Zori, and apartment list rent estimates. And these are on a year-over-year basis. And what you can see is that, there's been so much talk about Boise, and that you can see why. They have, on a year-over-year basis, according to apartment list, that their rents are rising at a clip of around 30%, even more so on a 3-month annualized basis. But also, if you look to the lower left, you'll notice that over the past couple months or few months, all of a sudden now we have the bigs, like I said, New York, San Jose, San Francisco, all of these, kind of big metro areas are beginning to see kind of accelerations in rents. So we have people coming back with the reemergence of the consumer, willingness to get out and spend and also find new places to live. Rents are rising, and it shouldn't be too much of a surprise. At some point we will see this kind of collapse between asking and collected rents. Part of this has to do with the eviction moratorium, which we'll get to in a moment. But let me back up just real quick. So the rent story is confusing, and it is a very critical part of CPI. Of core inflation, it's right around 30% OER just alone. That's not including the rent on primary residences. And with that being said, the OER is not necessarily going to track this data that we're showing you right here. Now, Zillow's data is very smooth, so it's going to be much more slower moving, kind of like OER. They look at the core 20%, really that 40 to 60 percentile range to get rid of outliers. They're also looking at asking rents. So if they're putting up a post for, hey, rent my place for X number of dollars, that's the price that they're looking at, which can be a little bit off actual rents. Whereas apartment list is kind of giving you more of a raw look. I don't think it's even really seasonally adjusted. We've done some seasonal adjustments with the data, and it is more a reflection of what's actually paid using an estimate. And they try to remove this luxury bias too. That's a whole nother topic, but typically the rents are a little bit lower than Zillow's. Now, OER, based on the questionnaire, is more or less, how much could you rent your home for if you could today? And that's a survey response, and that will also be slow to move with how the BLS calculates it. So the BLS is taking, kind of this monthly average of rents, and then they're looking at a 6-month average growth rate. And they're also lagging some of this data as they kind of work with these 6 panels of 6-month periods throughout the year. So this smoothing effect means that all this tremendous rise we're seeing from an apartment list is going to show up in Zillow data next. And then maybe, within the next, 3 to 6 months, this acceleration to a certain extent in more of a muted way is going to show up in the OER. Now, why that's critical again is getting back to CPI. It's 30% of CPI. And as these transitory forces begin to abate, like we've spoken about in past podcasts, the impact, the base effects of crude oil and some other commodities and energy in general is going to stop. Is not going to be offering this strong inertia to headline inflation beginning this month. So going forward, there's going to be a pull down on CPI. But in the background, the big thing that all investors need to worry about and think about is how much is OER going to rise and be a counterbalance, as well as wages. And that's what we're here to talk about today.
Our next chart focuses on the U.S. Metro rental prices, also apartment list versus Zillow.
Yeah, so here what we're doing is we have an interactive, so, for our clients, please feel free to play around with this. We've gotten a lot of inquiries regarding these two different data sets in general so that you can compare them. We've gone through the painstaking process of making everything match up in terms of making sure everything's seasonally adjusted, the metros make sense and match and so on. So feel free to play around with this. But showing here, this is the 3-month annualized growth in rents according to Apartment List and then also to Zillow. And you'll notice how smooth Zillow's figure is, showing about a 6.6% 3-month annualized growth rate versus almost 20% and rising from Apartment List. So Apartment List is going to be whippy. It's going to make a lot of headlines. You know, I think you've already seen that. Get ready for that to continue. There will be some fear mongering about how crazy rents have gotten, but this is kind of the environment that we're in, and doesn't necessarily mean OER is going to the moon, just because how the BLS calculates it with the smoothing and lag factors. And also too, I mean, you got to remember that this is going to be skewed to some of the big bigger movers like Boise's and so on. So yes, watch this data and also realize that, again, that OER is not going to track these apartment list rent prices.
So the rental market really heated up in January as people became vaccinated. They began to leave their homes for the first time in a long time. Where are we at now versus where we were at in January? Was at the peak?
Yeah, I mean, that's a great point. So what happened was, like January, February, we became, pretty bullish on risk and also on rents rising, for the fact that here's search activity on a rolling 5-week basis for a whole host of different topics via Google. So everything from just trying to find an apartment, getting on apartments.com, I'm curious about rent prices, I need a U-Haul, vacation rental, and so on. That had jumped very quickly, and pretty much almost all these topics, in January and February, and kind of endured for the most part through March. Now, we've seen this in a lot of other consumer activity. There's been somewhat of a pullback, a slowdown in spending after maybe the stimulus wore off. As we've already kind of emerged, and we're trying to figure out, are we going to keep buying goods, or are we going to get back into these services? Oh no, the Delta variant's here. All these kind of considerations, things have somewhat, slowed down. On the rent side, it would kind of half of these favorable topics, still rising while half are falling. So this doesn't mean the rent story is over. Just means that we'll likely see a little bit of a slowdown after this tremendous growth we've seen, really from January through May of this year. I think that we'll get things to peter out just a little bit as we go into the summer months. Some of this will depend too on the rent versus own dynamic. We've seen home prices just accelerate. Case-Shiller was just out this week with, absolutely wild numbers. As rents rise, if they're still a little bit cheaper, of course, than homes, there could be a drive into the rental market. But at some point, with how fast the rental market is improving, that will somewhat balance out. So I would, we're under the belief that this rapid growth in rents will cool to a certain degree, but it's still going to be a critical measure and additive to core inflation.
How about consumer financial stress?
This has been great to watch, and this is, again, search topics looking at on a 5-week rolling basis, and we're focusing almost most of our energy on this eviction moratorium. So searches for evictions and the moratorium would rebound really, about a month or two ahead of each extension or announcement by the CDC. So the CDC initially announced this moratorium, all the way back kind of as we were entering the fall of 2020. They extended it to start the year of this year, and then they kept extending it. And now the CDC came out and said, okay, this is it. Biden said too. This is the last extension. So we're extending this from June 30th to July 31st. This will be it. Get ready. And I think this will have an impact, on the long run, not immediately on OER and on rents, in that asking and collected rents are going to, converge. So collected rents can be distorted greatly. There's a lot of zeros, a lot of uncollected rents, whereas asking rents are clearly rising. So that is going to converge. Now, the financial stress part of consumers actually getting really concerned about this eventuality and about other things too, unemployment insurance, unemployment in general, having to make charge-offs or pay late fees, that all remains pretty depressed at the current moment, which is reflected in low volatility across most financial markets and in somewhat a still healthy equity market. So we'll have to see what happens after this July 31st marker. I think there will be somewhat of a series break. And if we get this appreciable jump in financial stress, concern about it, that will be somewhat of a game changer. And we'll see how widespread that is. Nobody really knows how big the impact's going to be. I'm not going to try to speculate. Just know that we're going to try to track it the best we can on a real-time basis via the search activity.
And Ben, what's your forecast for OER rising?
So what we've done is we've taken all of this really neat search activity that gives us a really good window into the psyche of the would-be renter, would-be buyer, their consumer, prowess, their financial stability, and so on. We use all this search activity from 2004 to current, build this model. In this case, it's a quantile regression, and see where should OER year over year be a year from now. Now, our model that kicks out a probability said, I think beginning 3 months ago, that we should have an 88% probability that OER year over year will be higher than where it is now, which was at the time at 2%. That seems to be underway. We ticked higher to 2.1% as of last month, but our estimate, median estimate, is only at a lowly 2.5% looking out over the next year. Now, that has something to do with a little bit of the slowdown we've seen in the consumer data as well as the rent related search activity. But looking at what could be a possible, if things do continue to accelerate or re-accelerate, what's a possible number to get to? And our 90th percentile estimate is right around 3.4%, which is not out of the realm of possibility. If I was a betting man, I think we're going to come in somewhere around that 2.5 to 3.4%, closer to the 3.4%, looking a year out. Now, its overall contribution, remember, it's 30% of core inflation. It doesn't mean that we're going to see, relative to the transitory forces that we'll be abating, we're going to see core inflation rocket higher thanks to 3.4% OER. It's just not going to happen unless these transitory forces aren't transitory. But that's what's going to make this all confusing, is OER kind of gradually rises after Apartment List, Zillow data, and others indicate that they are rising, and these transitory forces die off, even the base effects of crude oil. We're going to see this convergences, and we have to see how, in this muddled mess, where is core inflation going to lie? I think it's anyone's guess, but we still expect, somewhat of a modest regime shift higher in core inflation, thanks to OER, thanks to wages, and modest core inflation regime shift higher means that, we should be sustaining something around 2+% for somewhat of the long haul. And I think that's what markets are for the most part pricing in. If you look at inflation expectations, you have investors pricing in headline inflation running well above 2%. They have pretty strong conviction. Probabilities from inflation swap caps and floors are right around, above 80–90% for that eventuality. Markets right now are kind of like, okay, do we think 2.5% headline inflation is going to come, which we'd need in order to get core inflation to be at 2 or higher? Remember, core inflation runs on average 50 basis points lower than headline inflation. That's what they're trying to figure out. And I think that there is a good chance of that occurring due to what we've just discussed, rents and then wages, which is a whole nother topic.
So in other words, stay tuned as we continue to track this closely.
Indeed.
All right, thanks, Ben, for your thoughts today. Thank you, everyone, for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our two most prominent research offerings are Bianco Research and Arbor Data Science. For any questions, please contact Gus Handler at gus.handler@arborresearch.com.